Hey warriors, I hope you're all doing good. Today starts the first amendment lectures for your CA final May 24 attempt. Yes, to kick off this amendment lectures, we are starting with the first thing, which is the statutory updates and judicial updates which ICA has launched. Now, to quickly tell you as to where you can find these updates, you have to go to the ICA portal. In the ICA portal, you will find something called as BOS. So click on BOS, you will find on the bottom there is something called as amendments or developments. Click on the developments and amendments, go to finals. You will find two relevant for paper number 4, which is direct access. One is the judicial updates, one is the statutory updates. Now, if you go into the statutory updates, you will find various amendments which are showing. Yes, now they have also clarified what amendments and which chapters they are. They are from chapter number 4, chapter number 13, chapter number 15. Let me clarify this to you. The amendments which you see here are only those amendments which ICA could not incorporate in the study material which they launched. Which means after the material which was launched by ICA, if there were any changes by way of circulars, notifications or any other amendments, that is what is notified here. Fortunately for every one of you who has already purchased the concept guide from me, all these amendments are already a part of your material which you have. So therefore, this is not supposed to be discussed separately. Right? So statutory updates is not being discussed with you right now. As we do the amendments from the concept guide, these will automatically get covered. So please do not waste your time into reading this separately. Our material is already updated with all those things because it was issued on 31st October. Sounds good? Sweet. Let's move on to the next updates. We are looking at something called as the judicial updates. Now Rahul, what is this judicial updates? If you know, in CA finals, it's not just about the provisions which you're going to have. It's not just about the questions which you're going to have. ICA also tests you on some significant case laws which are there for your exams. Now, in your ICA study material, on the last page of every chapter, you'll find some 10 or 15 case laws where they will be discussing about some important judgments which has passed in the past. Separately, what happens is ICA has a practice to also release something called as judicial updates. Judicial updates are the latest case laws which has come in the near few months, which ICA feels are more relevant for you to know. A word of thought, these case laws are extremely important from exam perspective. Extremely important in the sense that in this paper, they have notified 5 case laws. Expect at least one of those mandatory coming in exams. Expect at least one of those mandatory coming in exams. Sometimes they've also asked 2 or 3. For those who understand the format of CA Final Direct Access, you know that one of the questions is about 8 marks or 6 marks in which they test you 3 case laws. They test you 3 case laws and they come and ask you to write any 2 of those. Yes, where you have to give the facts, you have to give the issue involved, you have to give their analysis and then give your final conclusions. In that, normally as a practice, what happens is out of the 5 case laws, you'll expect one of those questions there. Which means if you knew those 5 case laws, one of those questions can easily be answered and you will easily be able to score 4 marks or 3 marks as the case may be. Apart from this, if there is any other case law, that could also be tested in your compulsory level questions, right? So what we're going to do now is that we are going to read these 5 case laws, understand it logically, read what they have come and told, and then also give an analysis whether you should read it more as a theoretical case law or also read it as a practical case law which can be tested in your compulsory questions. Sounds good? Sweet. Let's start this journey and see how it makes sense. Case law number 1. Case law number 1. The case law comes and says Mahil Anand Filter System Private Limited versus ACIT 2023 456 ITR 29 SC. Now Rahul, from an exam perspective, do you have to remember this? Answer is no. Answer is no. ICI does not expect you to remember citation numbers and everything. It is enough if you remember 2 things. One, obviously the name of the case law, which means the party involved. In our case, it is Mahile Anand Filter Systems Private Limited versus ACIT. And also remember the court which has passed the judgment. Now, one good thing for you is that all the 5 judgments this time are from Supreme Court. So you don't have to worry. You just have to say Supreme Court decision and you can close it off. Yes. Now, Rahul, is the name of the case law very important from exam? I would still say no. I would still say no. Knowing it and writing it is good. You may be able to impress the examiner, but do not mistakenly also mention a wrong case law. If you mention a wrong case law name, the examiner has all the rights in the world to cut the whole thing even if the content is right, right? So if you can remember the name of the case law, go forward and present it. If you don't know it, leave it off. Leave it off. It is enough if you just come and say the Supreme Court in the case has clarified so and so. Some simple and close it off. Yes. Let's read the facts. The facts are like this. I'll give you an illustration, then we'll read the facts so that you understand this better. Assume a scenario where what has happened is there are two people, one is called as A, one is called as B. Now what A has done from B is, A has taken up premises on rent from B. So A decided that A will take a premises on rent from B. Obviously, normally in a lease contract, what happens, when you take a premises on rent, B will also expect to get something called as a security deposit. So what happened is, B went and said, I will give you the premises on lease. For that, you have to give me a security deposit. For that, you have to give me a security deposit. So A agreed to this and gave him a security deposit. With me? Yes. Now what happened is, they both were happily ever after going forward and taking the place and working it out. But one day there was a dispute between them. A decided that he wants to vacate the premises. A decides that it wants to vacate the premises and was ready to leave. It went to B and came and said, I am not happy with the premises anymore. There is a fight between us. Let's exit and go. You refund me back the security deposit. B also had the dispute and B came and said, I'm sorry, I will not refund you the security deposit because of reason number 1, reason number 2, reason number 3, reason number 4. Right? At this point of time, dispute started and finally A gave up. A came and said, okay, I am not interested about the security deposit anymore. It is better to let go of that rather than be with you anymore. Yes. So A let go of the security deposit. Now, obviously, the money which A let go is a loss for him. A decided that when it offers PGBP income, it considered this security deposit as a loss. So it mentioned in PGBP as loss on security deposit. Let's say in this case, I think the number was 5.8 crores. 5.8 crores and claimed the whole thing as a deduction. Matter got picked up for scrutiny. Assessing officer came and said, Dear assessee, I am not convinced with the fact that this security deposit is a revenue expenditure. I will not allow this expense because I feel this is a capital expense. What do I feel? I feel this is a capital expense and therefore this expense is not allowed as a deduction. Obviously, the matter got fought up and it went and reached the premises of Supreme Court. In the case of Mahela filter systems, Supreme Court passed a judgment where they came and said, just because you have written off the security deposit, it does not change the fact that it is still a capital expense and therefore you cannot claim this as a revenue expense and claim it as a deduction. I will not allow this as a deduction. That was the decision passed, which means in this case, the assessee lost the case and the department won the case. Facts clear? Yes. Let's read. It says, the issue under consideration is, can the foregoing a security deposit to settle a dispute be considered as a revenue expenditure? Read the next part. It says, when the assessee sought to vacate certain leased premises, disputes arose, and to end the dispute with the lessor, the assessee agreed to not claim the security deposit. The assessee agreed to not claim the security deposit of 5.8 crores. The apex court affirmed that the High Court, which held the amount of 5.8 crores could not be treated as a revenue expenditure merely because it was paid in the course of a dispute. It is evident that the character of the amount was of capital nature and remained so, although the assessee decided to forego the 5.8 crores of security deposit. Therefore, Supreme Court passed a judgment where it came and said, this cannot be treated as a revenue expenditure. You will continue to use it as a capital expenditure. Yes. Now, Rahul, this question, will you expect in the theoretical case law question? I would not, because the wordings are very small, the facts are very small. You may not get this as a 4-mark question. Expect this to be a part of your compulsory question. Expect this to be a part of your compulsory question. You may get a question where they will come and say the net profit includes a loss on foregoing of security deposit which is given to a landlord due to some disputes. In this case, you will come and say, since the apex court has decided that this is a capital expenditure, the loss has to be disallowed, full stop. The loss has to be disallowed and you will close the answer. Case law number 1, done. Facts clear, everyone? Yes? Sweet. Let's proceed to case law number 2. CIT versus KBD Sugar and Distilleries Limited. CIT versus KBD Sugars and Distilleries Limited. This is what the case law is. Again a Supreme Court decision. Again a Supreme Court decision. Let's look at the issue. The issue under consideration is, can a resulting entity set off and carry forward the losses of the dysfunctional unit of the demerged entity? Can the resulting unit set off and carry forward the loss of the dysfunctional unit of the demerged entity? The background is like this. The background is like this. Let's say, for example, there was a company called ABC. There was a company called ABC. Now, in this ABC, what happened is there were two units. For example, there was a unit for FMCG and there was a unit for hotels, for example. There was a unit for hotels. Now, FMCG was making profits. Hotels were making losses for many years. Because hotels were making losses for many years, they stopped doing operations. So, this thing completely stopped operations. Yes. After this happened, the ABC Limited decided that it does not want to keep the hotel units anymore because it is a dysfunctional unit. There is no point of having so much losses showing in my books of account and everything. Let's plan for a demerger. So what happened is, it was decided that this entity will be hived off. And was moved to a new demerged entity. Facts clear? Yes. Now, what has happened? There are two entities now. One entity is called as ABC Limited, which is running the FMCG. And now, let's say, for example, there is another entity called XYZ, which is running the hotels industry. Yes. Now, FMCG obviously making profit, so that's a separate discussion. XYZ is now making losses. In the current year, what happened is XYZ ended up making some profits. And therefore decided that the losses which was there from the past company, will be adjusted against the profits of the new entity. Now, if you recall the discussion of set off and carry forward of losses, the provisions of demerger come and say that when a demerger takes place, the losses from the demerged entity will move to the resulting entity to the extent of the net worth of the undertaking, and will be given a fresh period of 8 years to set off. So what happened is, the assessee of XYZ came and said, I have a profit in the current year. I will set it off against the losses which I have brought forward from the demerged entity. At this point of time, the assessing officer woke up and came and said, Dear XYZ, I am sorry, I will not permit the set off. This is because the entity which you have acquired, which is the hotel industry, is a dysfunctional unit. Now, because it is a dysfunctional unit, I don't know if you are aware about it, but just in case you know, there is this definition of demerger, which is a part of section 219 AA. This is a part of 219 AA, which comes and says that when a demerger takes place, the unit should be transferred as a going concern. So what happened is, the assessing officer came forward to XYZ and came and said, Dear XYZ, I will not permit the set off of the losses because the unit which was acquired by you is not on a going concern basis. It's a dysfunctional unit. And therefore the loss is not permitted. Obviously, the issue was not accepted and therefore was sent off to the courts. Now, both the parties are fighting out and they're trying to figure out whether this is eligible or not. Let's read the background now. Read. It says, Clause 6 of Section 219 AA lays down a condition that the demerger in case of a company's means transfer pursuant to a scheme of arrangement under Companies Act by a demerged company to one of its undertaking to any resulting company in such a manner that the transfer of the undertaking is taking place on a going concern basis. This has become an important criteria. The assessing officer has contended that the assessee was ineligible for the benefit of brought forward of losses since the fact that the demerged company was a dysfunctional unit since 1999 and therefore could not qualify as a going concern. Since the undertaking is not a going concern, the conditions of 219AA are violated, and therefore the losses are not eligible for set off, is what assessing officer comes and says. Let's understand what the courts decided. At the first level, it went to tribunal. At the first level, obviously after CIT, it went to tribunal. The tribunal opined that the words used on a going concern basis in clause 6 of section 219AA only means that the transfer should be on a going concern basis. The transfer should be on a going concern basis, and it does not mean that the undertaking should be a going concern on the date of transfer. Notice now how they are reading the law. They are coming and saying that the transfer should take place on a going concern basis. No one has ever come and told you that the undertaking should be a going concern. Yes, there is a difference between the undertaking being a going concern and the transfer taking place on a going concern basis. What is the difference? The scheme of demerger, which stands approved by the high courts and the jurisdictional courts, clearly establishes the fact that the transfer has taken place on a going concern basis. Meaning, now they are coming and saying, Rahul, when the court itself is coming and approving the demerger, it is obvious that the demerger is on a going concern basis. If not, it was just a hive off. Yes, slum sale would have taken place. Because the court itself is approving the demerger, there is no doubt but the fact that this is a demerger on a going concern basis. The assets, the liabilities, the employees, the debts, the obligations, the right, etc. of the undertaking immediately prior to the demerger stands transferred to the assessee upon demerger. The assessee, this amounts to transfer of an undertaking on a going concern basis. So the courts came and said that no matter how you tell it, the transfer has taken place on a going concern basis. A simple reading of the same makes it very clear that the assessee is eligible for the benefits of section 72A4. The act does not state that the undertaking being demerged ought to be a going concern at the time of demerger. Please mark this as important. They are saying nowhere in the act does it come and say that the unit should be a going concern. The transfer alone is sufficient to be on a going concern basis. Accordingly, the High Court held that if the unit is running as and profitable, the same would not be available for demerger. It would be incongrous to construe subclause 6 of 219AA to mean a running unit. They are coming and saying it is obvious that if someone is planning for a demerger, it is only because of the fact that the entity does not want the undertaking. Now, if it does not want the undertaking, it is obvious that it will have losses. If you come and say that every time it should be a running unit and then only you should do a demerger, then the intention is defeated of the section, and therefore that is not the way you have to interpret the law. The scheme of the demerger has been approved by High Courts, and therefore the assessee was entitled to set off the brought forward losses under section 72A4. Since High Court has approved it, Supreme Court also came and said, yes, what High Court is saying is right. Let's not dispute it. Let's not dispute it. In simple words, Rahul, what is the issue? Can a resulting entity set off the losses of a dysfunctional unit which it acquired on demerger? The answer is yes. The answer is yes. Simple words, the answer is yes. Now, Rahul, what do you expect? Now, this can be the theory question. This can definitely be the theory question. You are not expecting questions relating to demerger standalone basis. So, you can expect a question on this in the theoretical level. In the theoretical level, a very fairly good question which they can test you, because the content is also big. The content is also big. Facts clear? Yes? Great. Case law number 3. Sikandrabad Club versus CIT. Sikandrabad Club versus CIT. Now, Rahul, what is this case? A peculiar case, I'll tell you. A peculiar case, I'll tell you. The facts are like this. The facts are like this. There is a club, Sikandra Club. There is a club called a Sikandra Club. So, I'm going to name it as SCC Club. I'm going to name it as SCC Club. Now, what happened is, in this SCC Club, there were various people. Yes, A, B, C, D, etc., etc. So, there were A, B, C. But beyond that, they also had banks in them. Which means the bank is also a member of the club. The bank is also a member of the club. Now, it so happened that because Sikandrabad Club is having money, Sikandrabad Club will not keep the money in their pocket. They have to put it in a bank. So, what happened is Sikandrabad Club went to the bank and came and informed the dear bank, I have money in my hand. I have money in my hand. In order to ensure that I keep it safe, I am giving this money to you. Create an FD for it. Create an FD for it. Bank ended up creating an FD. Now, obviously, when you create an FD, you will also get interest. You'll also get interest. So, what happened is Sikandrabad in the current year earned interest on the FD which it created with the bank. Now, coincidentally, the bank is also the member of the Sikandrabad. If you remember the provisions of cooperative society, normally there is a concept called as principle of mutuality. Normally there is a concept called as principle of mutuality. Now the principle of mutuality comes and says that a person cannot earn income from itself, which means if it is going to provide any services to its members, the benefit of which is going to come to all the members, and in that case the income will not be taxable. The income will not be taxable. Now smartly what happened is Sikandrabad went to assessing officer and came and said, dear assessing officer, the deposit which I made is with my own bank. Own bank in the sense the bank which is my member. The bank which is my member, and therefore the interest which I am earning from the FD is also money which is earned from my own member. This is a principle of mutuality, and therefore I do not want to offer this as income. I do not want to offer this as income. The issue then went to assessing officer, and assessing officer now has to decide whether the interest which is given by the bank which is a member of the Sikandrabad club on an FD which is created by Sikandrabad club is an income or not. Is an income or not. Facts are clear? Yes, let's read. Now I've already explained the facts to you, so I'm not going to get into the details. The analysis is as follows. The principle of mutuality works on the following three cases. You have to do triple test for you to see whether it's a principle of mutuality. Test number 1, your complete identity between the contributors and participators. You should know who is involved with whom. Who is involved with whom. Second, the action of the association or the clubs. The action of the participators and the contributors must be in furtherance of the mandate of the association or the clubs. Must be in furtherance of the mandate of the association or clubs. The mandate of the club is a question of facts that has to be determined from the memorandum or articles of association. Meaning the articles and the MOA should come and tell you as to what is the mandate between the contributors. Yes or no? Yes, this is what the facts are. Third, there must be no scope for profiteering by the contributors from a fund made by them which could only be expended or returned to themselves. Now this is the most important part. They are coming and saying there should be no scope for profiteering by the contributors which could only be expended or returned to themselves. So there should not be any profit element when you do transaction with your contributors. Applying the above principles to the fact of the case, it was observed that in relation to the transactions, which is the deposit of the surplus funds in the banks which are members of the club, the principle of mutuality applies only till the stage of deposit of the funds. Now understand, they're not saying principle of mutuality is applicable. They're coming and saying the principle of mutuality is only applicable till the date on which you deposit this money into the fund. It stops on the date on which the deposit happens and would lose its application once the funds are deposited as fixed deposits in banks. They would lose its application once the funds are deposited as fixed deposits in banks. This is because the funds would be exposed to commercial operations. So the court came and said that because you are giving an FD, now the money which you have given to the banks, obviously the bank will not keep it with itself. The bank will use it for commercial banking operations, in the sense that they will take the money, give it to someone else in the form of loan and all those things, which means it has become open for outside circulation. Which means the deposits could be used for lending to third parties and earning a higher interest thereon by paying a lower interest rate on the fixed deposit to the club. So they'll give it to an outside person as a loan, get higher interest, and then keep the differential money which it is going to give to the club. The bank utilizing the fund for the club in the fixed deposit receipts for their banking operations would be completely rupture the principle of mutuality. The money which they are holding is now not in the capacity as a club member, but more in a commercial capacity, and therefore this will ruin the principle of mutuality. As a result, the element of complete identity between the contributor and the participator would be lost. Consequently, the first condition of the mutuality claim is not satisfied. Since the complete clarity between the contributor and the participator is lost, they have lost the identity of mutuality, and therefore the condition number 1 is failed to be achieved. If the surplus fund is not applied for the common purpose of the club or towards the benefit of the members directly, but is invested in a third party, who has the right to utilize the said funds, subject to the payment of interest on it and repayment of the principal when decided by the club, then in such an event the club loses its control over the funds. So they're coming and saying, since the fund is given to the bank and bank is going to use it for third party applications, in that case the fund loses its identity, the club loses the identity over the funds and does not have control anymore. This is not a principle of mutuality. Furthermore, as the bank utilizes the fixed deposit amounts for its banking business, the club's identity with the fund is compromised. The club's identity with the fund is compromised. The bank's ability to derive profits by lending amount at higher rate interest while paying lower rate interest to the fixed deposit made by the club further disrupts the essential identity between the contributors and participators in a mutual relationship. They are just repeating the same thing again. Conversely, when the club provides its facility to a member to contribute to its income, the principle of mutuality applies due to the identity between the contributor and participants. However, where the same facilities are offered to non-members or to the public to generate additional income, it transforms into commercial operations and the principle of mutuality no longer applies. They are just repeating the same thing again. Yes. Next. For the triple test to apply to the different and varied transactions of the club, it is necessary to lift the veil and discern the nature of each transaction. Whether there is a third party intervention which is the reason of earning the income, or it is an income generated between the member of the club, as such that is only between the members of the club. You need to lift the veil and check as to where are you generating this income from. If you are generating this income from your member directly, then there is no problem. But if the money is going to come from a third party because of a commercial bank operation, in that case it is not called as principle of mutuality. Accordingly, the Supreme Court held that the interest income which is earned on fixed deposits made with the bank by the appellant club has to be treated like any other income from source within the meaning of section 224. So they came and clarified that nothing doing, whatever income you earn, this income will be liable for taxation as IFOS. Conversely, if any income is earned by the club through its assets and resources from persons who are not the members of club, such income would also not be covered under the principle of mutuality. If you earn this income from some other third party also, it will not be liable for principle of mutuality. In this case, what they're doing is they're coming and saying ignore the bank. The third party to which you have given the money is what the criteria is, and since you have given it to a third party and generated extra income out of it, this will not be treated as a principle of mutuality. Yes. So Rahul, what is the issue under consideration? Does the principle of mutuality apply to interest income earned on fixed deposits made with the banks by the clubs if such banks are members of the club? Answer is no. This will continue to be taxable as IFOS income. Again, since clubs are not the criteria for your exams, this will again come as a theory question. Keep that in mind. Yes, 3 case laws done for us. Can we proceed? Let's proceed. Case law number 4. CIT International Taxation versus Air India Limited. Now, very peculiar case. I'm not sure why did it reach the level of Supreme Courts and all to make a dispute out of it, but a very peculiar case. Even you and I know the answer, but still for some reason it is there. The facts are like this. Imagine a scenario where what has happened is there is a person called Mr. A who is doing a transaction with a non-resident. A payment is supposed to happen to a non-resident. Yes. Now, regardless of what benefits it is, assuming it is royalty payment, obviously a normal person will check for 2 things. One is the rate as per income tax, one is the rate as per DTAA, and do whichever is beneficial for the assessee. Yes or no? So what happened is, let's say for example, this payment was treated as a payment under India-US treaty. This payment was a payment made under India-US treaty. So what happened is the A made the payment to NR, and as per India-US treaty, assuming the rate was 15%. Mr. A went forward and deducted TDS at the rate of 15% and made the deposit to the government. When this case was picked up, the assessing officer came and asked, "Dear Mr. A, did you obtain the PAN number of the non-resident?" Mr. A said, "No, sir. It's a non-resident. He does not have a PAN number in India. He gave me the TRC, tax residency certificate, based on which I applied the DDAA benefits and I gave him 15% rate. Assessing officer came and said, "Dear assessee, understand the rate of 15% which you have right now should be compared with the actual rate which is given in the act. But in this case, what has happened is the non-resident has not furnished you the PAN number. and therefore comes in a section, if you all know, called as section 206AA. Section 206AA. This section 206AA comes and says that when a person does not furnish the PAN number, the rate automatically becomes the actual rate or 20% plus surcharge plus cess, whichever is higher. So therefore, the assessing officer came and said that, dear Mr. A, since you have not got the PAN number of the non-resident, you should have deducted TDS at the rate of 20 plus surcharge plus cess. Assessee came and said, sir, I understand what you're saying, but please understand this is a non-resident. Do you expect me to really go and ask him to get a PAN number in India for every single transaction? More so for the fact that DTAA is coming and saying a 15% rate. Is the non-resident not eligible for a 15% beneficial rate? Assessing officer said no. Since 206AA comes and says, notwithstanding anything contained in chapter 17B, this becomes an overriding section. And therefore the 206AA apparently overrides DTAA also, it seems. Assessing officer came and said the 206AA provisions will override DTAA provisions also, which means going forward, if you have a non-resident and the non-resident does not get a PAN number in India, always do TDS at the rate of 20%, even if DTAA gives a lower rate. Now, you and I both know this makes no sense. But for some reason, people had a dispute around it, and therefore they reached the courts. Yes. Now, in the courts, what exactly happened? Let's read. The assessee has taken an engine on lease under an agreement with a foreign company, a tax resident of Netherlands, having no permanent establishment in India. The foreign company also does not have a PAN in India. The assessee company deducted taxes at source at the rate of 10%. Now, for those who are reading May 2024, you will know that in the current year, royalty, FTS and all has become 20%. Don't confuse yourself with that. This is a normal provision. This is a TDS happening on lease rentals. So nothing to do with any FTS or royalty. This is a normal income. Maybe other income, there is a rate of 10% given in India, Netherlands, DTAA. That is what they're talking about. Yes, so don't confuse yourself with 10%. What is that basis and everything? Don't remember all those things. See, it says the assessee company deducted taxes at source at the rate of 10% on lease rentals as per the provisions contained under DTAA between India and Netherlands. However, the revenue contended that in the absence of furnishing of PAN, the assessee was under an obligation to deduct TDS at the higher rate of 20% following the provisions of 206AA. Assessing officer is coming and saying, forget what is there in DTAA and all, because this person has not furnished the PAN number to you, he is eligible for a higher rate of 20%, which means 206AA will override DTAA, it seems. What does the court come and say? The High Court noted that the 92 provides the provisions of DTAA would override the provisions of the Act. Notice one thing very carefully. 92 is applicable on the whole of the Act. In case where the provisions of DTAA is more beneficial to the assessee. Even the charging sections of section 4 and 5, which deal with principle for ascertainment of total income, are also subordinate to the principles which are given under section 92. So they're coming and saying even scope of total income does not have a power over DTAA. DTAA is the better scenario case. It has more power. Thus, insofar as the applicability of the scope and rate of taxation with respect to the impugned payments made to non-resident is concerned, no fault can be found with the rate of taxation which is invoked by the assessee based on the DTAAs. No fault can be found. The provisions of tax withholding, that is section 195, would only apply to sums that are otherwise chargeable to tax under the Act. The provisions of DTAA along with sections 4, 5, 9, 4 is charging section, 5 is scope of total income, 9 is income deemed to accrue or rise in India, 90 is DTAA, 91 is cases where you don't have DTAA. All those cases are relevant while applying the provisions of DDS. Therefore, section 206AA cannot override the charging section. Section 206AA cannot override the charging section of section 4 and section 5 of the Act. Accordingly, the High Court upheld the tribunal's ruling that where the tax has been deducted as per the beneficial provisions of DTAA, the provisions of 206AA cannot be invoked to insist the tax deduction at the rate of 20%, having regard the overriding provisions of 92. The Supreme Court upheld the decision of High Court, resulting in the dismissal of the SLP filed by the revenue. So there itself coming and telling, boss, forget all those things. It doesn't matter. Because because the overriding provisions will not apply in case of 206 doubling. Will not apply in case of 206 doubling. Facts are clear? Yes, yes, sweet. Let's proceed forward. Let's start with case law number 5. CIT versus Industrial Development of India Limited, Supreme Court decision. Now, let me put this in a illustration format to you. Assume a case where the assessment is of assessment year 22-23. You had filed your returns on time and the assessment was picked up for scrutiny. During the course of original assessment, the assessing officer passed an assessment order on 31st March 2024, which is nothing but 12 months from the end of the relevant assessment year, and he has made 3 disallowances: depreciation, 40A, which is disallowance of TDS, and 40A3, which is disallowance of cash payments. Then, after the original assessment was closed, the assessing officer also launched a reassessment on you, and assuming that the reassessment proceedings were all clean and clear, he launched the reassessment proceedings on 31st March 2026, in which he made 2 more disallowances. One is related 40A2, payment to specified persons, and one is a TP adjustment. At this point of time, what has happened is the PCIT of the assessing officer, or the CIT of the assessing officer, or the PCCIT or the CCIT, whoever it is, has come forward and said that the orders which are passed by the assessing officer is erroneous, because it is not in the interest of the revenue and the assessing officer may have missed out a few things. Therefore, the PCIT or the CIT proposed that on 31st March 2028, he will launch something called as 263 revisionary proceedings. Yes. Now, during the course of revisionary proceedings, the CIT came and informed that I am launching this reassessment proceedings for the depreciation disallowance which was made in the original assessment, because I feel that the assessing officer has only disallowed, for example, 10 crores, but he should have disallowed 50 crores. Now, the question which then came up before the court is, the issue which is in place is the depreciation, which is a part of original assessment. If you understand section 263, section 263 comes and says that the order which should be passed under section 263 should be passed within 2 years from the end of financial year. It should be passed from 2 years from the end of financial year in which the AO order was passed. 2 years from the end of the financial year in which the AO order was passed. Now, the question which then came up before the courts is, Rahul, when you're looking at the disallowance being rectified of depreciation, should the CIT pass the 263 order within 2 years from 31st March 24, or can it consider the latest reassessment order as the starting point for it to start the revisionary proceedings? Which means, if the CIT has launched the revisionary proceedings on 31st March 27, can it be called as time barred because the issue and discussion is of depreciation for which the due date is already expired? This is the question which has come up before the courts. I hope this makes sense. Yes, let's read what the courts have to say. Section 263 provides that where the PCCIT or CCIT or the PCIT or the CIT considers that the order which is passed by the assessing officer or the transfer pricing officer is erroneous, insofar that it is not in the interest of the revenue, he may pass a revisionary order. This revisionary order has to be passed within 2 years from the end of the financial year in which the order sought to be rectified was revised. In our case, we have 2 orders, one is original, one is reassessment. Analysis. As observed and held by the court in earlier decisions, once an order of assessment is reopened, the previous assessment order will be held to be set aside. So many courts have now come and told that the moment you pass a reassessment order, the original assessment order is assumed to be set aside and the revised reassessment order becomes the final order. The whole proceedings would start afresh, but the same would not mean that even when the subject matter of reassessment is distinct and different, the entire proceedings would be deemed reopened. So they're coming and saying, even though a fresh proceedings are starting, it does not mean that the entire proceedings would be treated as reopened. It means that only in case where the issues before the Commissioner of Appeals at the time of exercising powers under section 263 relate to a subject matter of reassessment would the limitation start from the date of reassessment. So here the Supreme Court came and clarified that if you want to launch a reassessment, the due date will only start from the date of reassessment order in case the issues under consideration are of reassessment order. However, if the subject matter of the reassessment is distinct and different, in that case, the relevant date for purpose of determining the period of limitation for exercising powers would be the date of original assessment order. So they are coming and clarifying, if the issue which is going to be revised is nothing relating to the reassessment order, then the original assessment order would be the date on which you have to consider. In my example, if the issue was relating to depreciation, then the assessing of the PCIT can only pass a revisionary order by 31st March 2026. If the 263 order is not passed by this period, then this order would be treated as time barred and therefore will not be valid, Accordingly, the Supreme Court held that the issues before the Commissioner while exercising the powers under Section 263 related back to the original assessment order, and therefore the limitation would start from the original assessment order and not from the reassessment order, thereby making the revisionary order as time barred. Which means, Rahul, does the limitation period for exercising reckon from the date of passing original assessment rather than reassessment? Answer is yes. It would start from the original assessment date. Yes. Summarizing all the 5 case laws quickly. Case law number 1 spoke about the fact that if you forego your security deposit, it would be treated as a capital expenditure and not a revenue expenditure, therefore will not be eligible for deduction under PGBP. Case law number 2, if at all there is a dysfunctional unit which you are going to demerge, then in that case the losses of the dysfunctional unit can still be carried forward and set off by the demerged entity, because the transfer should happen on as a going concern and not the undertaking itself. Third, when you are going to keep your surplus money in a fixed deposit maintained with a bank in which bank itself is a member, it does not change the fact that the money which you are going to get, the interest which you are going to get on the FD is still an external interest, because the FD which you have created with the bank will be used by the bank for external commercial loans, and therefore there will be no concept of principle of mutuality here. The income which is coming from the FD will be taxable in the hands of the cooperative society. Case law number 4, here they are coming and saying that if at all a non-resident is entering into a transaction with a resident and the payment is done by a resident to a non-resident as per the beneficial's provisions of DTAA, then the DTAA rate is what would apply. The assessing officer cannot contend that the PAN number is not available with a non-resident, and therefore section 206AA applying a higher rate of 20%, that would not apply. DTAA provisions would override even 206AA. Finally, the case law number 5, which comes and clarifies that if you are going to open revisionary proceedings, you can only open revisionary proceedings relating to the order for which the revisionary proceedings is sought to be revised. If the issue is a part of original assessment, revisionary also has to be done within 2 years from the date of original assessment. You cannot come and say that the reassessment order will be the starting point when the issues are pertaining to original assessment. 5 case laws for you to read for your exam purposes. Yes. Please keep these 5 case laws in mind. If you can remember the name of the parties, good for you. If you cannot remember also, it's fine. Just make sure that you understand that these are all Supreme Court decisions and answer them accordingly. Rahul, what is the fact pattern as to how you need to write this in the exam? You need to answer 4 things. One is the facts of the case. Second is the analysis of the case. Third is your understanding, and fourth is the conclusion. For example, in exam, if they give you a case study scenario where they give you some examples, first of all, you will come and write the provisions, where you will come and say what are the actual provisions of the act. Second, you will copy paste the facts of the case in a summarized format. Don't just like that copy paste the whole thing. Prepare a summary. For example, in this case, last case, I will come and say section 263 states that the PCIT, CCIT, PCCIT or CIT can pass a revisionary proceedings in case it feels that the order is prejudicial to the interest of the revenue. However, this order has to be passed within 2 years from the end of the financial year. In the present case, the CIT has launched the revisionary proceedings on so and so date, which is considering the reassessment order in mind. However, the issue under discussion is relating to original assessment. the apex court in the case of so and so, if you remember, or you can just come and say the facts of the case are similar to a case passed by an apex court, wherein it was held that if the issue under consideration is pertaining to original assessment, the revisionary proceedings also has to be launched within 2 years from the date of original assessment and not from the reassessment. In light of the decision, it can be held that the order which is passed by the CIT is barred by the period of limitation, since this is passed beyond the due date given in the original assessment. Therefore, the order passed should be treated as void and the proceedings should be null and nullified. If you write this much, you get your 4 marks for your exams. In simple words, write the provision, summarize the facts, give your reference to the case law, give the conclusions what are arrived from the case law, then finally conclude it as to what will happen in your case. This is your format for your exam. If you follow the same format, you will get the right marks. Like I said, out of the 5 questions, I'm seeing 4 are theoretical questions. 1 is a sum related question. So expect the first question to be a part of your compulsory question and expect the balance 4 to come as a part of your theoretical case law related question. Please understand, this question will not be a part of your last one. It will be a part of a 4th or 5th question. So therefore, it is an important question for you to answer in your exams. Focus on the case laws, very important from exam purposes. I am going to put this video as a part of my amendment lectures. So you'll find it along with the amendments. Please do focus on these also before you go for your exams. Yes, in the following few days, you will also start seeing the amendment lectures being uploaded for the whole CA final. Please watch out for the videos. If you feel like this is exciting and interesting for you, and if you feel like there are other people who can get supported from this, please do refer them the channel so that they can also come and benefit from all of us. Yes, signing off for today. I will see you all very soon with the next level of lectures. Take care, people. Have a nice day.